what are the range of viable purchase prices that still allow the sponsor to meet their required rate of return, still allow the lender to get paid back while maximizing the purchase price to our client. Okay, so pretty much any time there's a deal, a leverage buyout, anybody who's involved is running a model. All right, the private equity firm's running a model, the lender's running a model, investment bankers running a model if they're representing the company on the sell side of the transaction, etc. And then again, as we mentioned briefly earlier, and as we'll see tomorrow, we can use this as a fourth valuation methodology, maybe to figure out what is the maximum purchase price that can get paid for a company in a leveraged buyout, and use that as a fourth valuation methodology in addition to the other three we've discussed in class. Kind of a fun exercise. We'll go into that in much more detail tomorrow. Let's talk a little bit about what the model is going to look like. We're not going to spend a whole lot of time here because, kind of like with financial modeling last week, it makes a lot more sense when we're doing it. So what I want to do is kind of outline the broad structure of what the model looks like, and then we'll just start building one. And then once we've built one, what I would say is go back, read the rest of these slides. These slides give a very detailed step-by-step approach to how to build an LBO model, and it'll make a lot more sense once you've actually done it. Okay, so what we're going to do today is we're going to take the financial model we built last week, same model, so those numbers are going to look very familiar to us, and we're going to now we're going to look at this company again as if we're the private equity firm evaluating a purchase of it. So we're going to have things like a purchase price assumption. We'll have a sources and uses of cash statement. Right? And sources and uses of cash, kind of like a balance sheet in one respect, in that sources of cash have to equal uses. Just like a balance sheet has to balance, source and use has to balance as well. If we need $500 million of cash to do a deal, we better be able to raise $500 million of cash, otherwise we're not doing the deal. Right? So that's kind of what a source and use is all about. Capitalization, so we'll figure out how much debt, how much equity do we need, what does that capital stack or that capital structure look like, and we'll build, obviously, enough of a model to give us a sense for what the return is going to look like on the deal. All right, so the first thing we'll do today is we're going to build a purchase price calculation or a transaction summary, basically saying what is the valuation of this company as we buy it. And this is usually a lot more than just putting together a table and pulling an EBITDA multiple out of the air and deciding that's the price. Usually what happens here, this is usually determined based on a full valuation analysis. All right, so the private equity firm is probably doing a comparable companies analysis, probably looking at precedent transactions both by strategic and financial buyers, figure out what the optimum value, the right control premium to offer would be, probably doing a DCF to arrive at a value. Our model is going to be a little more straightforward. We're just going to assume a multiple of EBITDA, apply that to the company's trailing EBITDA. That's going to be the enterprise value of the deal. But just recognize that in a real life situation, you'd probably be doing a full valuation in order to get to that. Okay, so we're going to calculate an enterprise value. We're going to then calculate what is the implied equity value of the deal. If we back out debt and add back cash, then it will give us that. Once we do that, if we know how much we need to pay for the equity, and if we're going to refinance the debt, and in most LBOs the debt gets refinanced, especially large transactions. If the target company has several different lenders that have lent them money, maybe in a syndicate, oftentimes it's just easier to completely refinance that debt and raise new debt as opposed to trying to go in and negotiate with a syndicate of 20 different lenders, trying to get them to agree to a radically different capital structure on the deal. That can, as you can imagine, that's probably a very difficult undertaking. Okay, so what we're going to do is we're going to buy out the equity, we're going to pay down, or we're going to refinance the existing debt. So we need to raise enough cash to do those things. And then like everything else in finance, we're going to have to pay some fees. We're going to have to pay some transaction fees. Going into the deal, if we're the private equity firm, one of the things we're going to have to do is pay probably a financing fee. We'll probably have to pay an investment bank to go out, help us raise the amount of debt necessary to do the deal. This would typically be provided by the leveraged finance group of an investment bank. Right? We'd have to pay them. Right? There might be, if we're getting represented by an investment banker sort of for M&A purposes, probably have to pay an investment banking fee as well. Or maybe we're big enough, maybe we do that on our own, maybe we don't engage a banker for that. In this model, we assume that we will. And then as always, we're going to have to pay the attorneys, we're going to have to pay the accountants, we're going to have some other due diligence costs associated with the deal. So altogether in this transaction summary, we got to buy out the equity, we need to refinance the debt, and we've got to pay fees. If we add all those things together, it will tell us how much cash do we need to raise. Remember, sources need to equal uses, so how much cash do we need to raise? And that's when we start working on our sources of cash statement, or our capitalization assumptions. What we're going to do is we're going to go through, we're going to assume that the company is going to have access to 4 different types of debt. We're going to have access to a revolving line of credit. Then we'll go out and we'll raise a term loan, probably from a commercial bank. Right? There'll be a senior secured lender, as we've talked about before, Chase, B of A, etc. We might sell some bonds. Actually, we're going to assume that we can sell some bonds here as well. Have a junior piece of debt, probably a second lien piece. And then finally, we're also going to go out and get some mezzanine debt to sort of round out our capital stack to get us to the optimum leverage that we need to get. Right? What's a mezzanine piece? Just for our refresher, everybody know what I mean when I say a mezzanine piece? Mezz piece is similar. It feels like debt, and then on the tail end, we're going to give that lender a little bit of equity as well in the form of a warrant. This is an unsecured piece of debt, so this lender is at the very, very bottom of the capital stack. Right, they're before equity, but they're behind 2 other lenders, and they're taking a lot of risk in the fact that they're not secured. So in order to compensate them for that, we need to give them a warrant. So we're going to be able to account for that. And then finally, we're going to have how much equity are we putting in the deal. So of the private equity funds, of our fund that we've raised, say we've got $1 billion fund that we've raised, in this case, we're going to put $104 million into this deal. All right? That is our equity contribution. All right, so that's sources and uses of cash. Again, at the end of the day, they need to be equal to one another, otherwise there's no deal. All right, so again, capital structure alternatives. I think we've talked about a lot of this. When we talk about the amount of debt we're going to raise, oftentimes we refer to that as a multiple of EBITDA. Remember earlier we talked about a lot of these deals being kind of 4 to 6 times EBITDA. The deal we model today is going to be 4.5. And each of these individual pieces, we're going to speak of them in terms of their multiple to EBITDA. So we're going to get a term loan of 2 times EBITDA. We'll get some senior bonds of 1.5 times. We'll get a mezz piece of 1x. And then the balance needs to go in as equity. That's that $104 million. We're also going to look at this not just as a multiple of EBITDA, but also as a percentage of the total capitalization. Another way to express leverage in this case is to say that debt is 72%. It's 72% of total cap. Leverage is 72%. Equity is 28%. And then we'll specify interest rates. In this case, we distinguish between cash pay and PIK because one of our pieces, our unsecured notes, another reason why it's more of a risky piece is because the lender doesn't get their interest in cash, they get it paid in kind. So it's just getting accrued and accrued over time. They don't really know exactly when they're going to get their interest paid. They're very dependent on the private equity firm's ability to exit the deal and take them out and pay them for that interest that's been accrued over time. And then in this case, one of our lenders, that mezz lender, is going to get a warrant. So that's where we're going to reflect that in our capitalization table as well. Once we know what our capital structure is going to look like, and I apologize for this being so small, we had to fit it on the page, but we're going to create what we call a pro forma balance sheet. So again, pro forma balance sheet, kind of think of it as what does the company look like a split second before the deal gets done? What changes or what adjustments do we make as a result of the deal? Remember, we're paying off some old debt. We're bringing on some new debt. Anytime a deal gets, most deals anyway, Usually some goodwill gets created, so that will come onto the balance sheet. We're buying out the old equity. We're investing new equity into the deal. All right, so what does the company look like a split second before? What are our transaction adjustments to reflect all of those changes we just discussed? And then what does the company look like right when the deal closes? That's what we mean by pro forma balance sheet. And we need this for a couple reasons. Number one, it's interesting to see what the balance sheet looks like right after the deal, but we also need to integrate this into the model we build and really key off of this going forward, especially when we consider our cash flow statement. Remember, the cash flow keys off changes in the balance sheet accounts, so that needs to be integrated. This pro forma balance sheet needs to be integrated into our financial model. We're going to do that first thing tomorrow. Okay, so we'll integrate that into our model as we see here. Create space for that. We'll drop that into our model. And then we are basically going to go line by line through our income statement, balance sheet, cash flow, debt schedule, and adjust for what this transaction means in terms of the company's financial statements. Okay, then finally, as I've said, the big goal here is to figure out what is this number, what are the returns. So once we have a sense for what the cash flows are for that holding period, private equity firms typically try and hold investments 3 to 5 years. They need to exit in a relatively timely manner so they can return capital to their investors. Right. So we're going to assume a 5-year hold. We need to know what those cash flows look like for those 5 years. And then we need to make some assumptions as to what we think we can exit at. What is the value at the end of year 5 that we believe we can sell the company for? And once we have all of those things, we can calculate our returns. Okay, so we'll model the sale. In other words, at the end of year 5, we're going to model the sale as a multiple of EBITDA. That'll give us an implied transaction value. Just like over here, we get our total enterprise value, we pay off the debt, we get down to what's left for equity. Actually, we pay off the debt, we pay off fees. We get down to what's left for equity. That gets split between the private equity fund and that 5% to our mezz lender. So we know what percentage of the deal goes, percentage of the distributable cash goes to each, and then we create our returns analysis. Basically an IRR analysis, internal rate of return. If you've ever done that in Excel, it's pretty easy to set up. And this is the IRR table that we're going to create. And ultimately, at the end of the day, this is the number we're going to key on. We're going to compare this IRR. In other words, if this is a 19% IRR, how does that compare to our hurdle rate? If our hurdle rate is 25, then it's probably not that good of a deal for us. If it's 15, this might be something worth considering. All right, so at the end of the day, that's where it really depends on what is our hurdle rate, what is the relation to the IRR implied by the deal. We'll also do an IRR for the mezz lender because they're getting something more than just their interest and their principal paid back. Okay, they're getting value in the form of that warrant, so their IRR is going to be a little different than just their interest rate. We'll calculate what that return looks like because at the end of the day, the mezz lender will also have a return hurdle. That is some benchmark that they need to achieve in order to maximize their own returns. If the deal implies a 13% IRR, if their hurdle's 12, might be a good deal. If it's 15, may not be so good. Same logic applies. All right. So at this point, let's actually break away from here. What I want to do is go into the model and actually build it. Once we've done that, then I want you to be able to come back, read the rest of these slides, review even what we've just covered. I think it'll make a lot more sense at that point. That really just introduced the structure of the model. All right, so I'd gone into my folder 4-5 LBO modeling, and I've opened up the file LBO model shell. Same exact file you have. And what we're going to do is we're going to use these assumptions that were on the back table there. We're going to use these assumptions and the instructions here to walk through and build an LBO model. And this is something that if you look at these instructions in kind of a general sense, they can be really useful if you see an LBO model or if you have to build one sometime in the future. This can give you a sense of all the different things you need to do. So this is valuable. I'd probably keep this and you can use it as a frame of reference at a conceptual level. Everybody able to open that model, that shell? Okay, first thing, let's make sure that we're running in manual mode, just as we did last week, and that we're set up for iterative calculation. My model is, yours should be as well. Right? If it's not, make sure you check manual, make sure you enable iterative calculation. Again, that enables Excel to handle that circular logic that must exist in our model. Let's look at these tabs just so everybody can navigate around a little bit. We've got 4 tabs across the bottom. The first one is our source and use. These tables should look pretty familiar. It's exactly what was in the slides. We're going to go through and populate these. Okay, so the first thing we're going to do is our transaction assumptions. We'll build a source and use. At that point, we're going to go to our pro forma balance sheet. So control page down will take us to our pro forma balance sheet. Okay, we're going to link to our historical. We're going to do the transaction adjustments. We'll get our pro forma balance sheet on the right-hand column. Not going to really make many, we'll make very few changes, I believe, to the assumptions tab. We're going to leave a lot of the operating assumptions alone. We're going to just assume that we buy into the fact that the company is expected to grow 5% a year and have 60% gross margins and all of that. Okay, but in a real world scenario, you might make some adjustments here on the operations side as well. And then finally, we're going to work on our model tab. This should look exactly familiar. This should look very familiar, exactly what we did last week. Okay, so we're going to then model. We're going to modify this model to account for the LBO. We're going to insert a column here, drop in the pro forma balance sheet, and then make some changes to all 5 years in our forecast period. All right, well, let's go back to our source and use tab. What we're going to do is we're just going to start building the model off of these instructions. So right at the top, and I'm on the side that has the IBI logo. That's the first page. So right at the top of the first page, our transaction date or our closing date is going to be December 31st, 2008. So in that cell, I want to enter 12/31/08. You'll see that it's pre-formatted, just like all of our other worksheets here. Right, our hard codes are blue. Our output is black. So closing date of 12/31/08, that's the day we assume we're going to buy this company. We're going to buy it as a multiple of its latest 12 months EBITDA, so the next thing we need is 2008 EBITDA. We don't want to hard code anything here because we can actually go to our model. So that's what I'm going to do. I'm going to link to my model. I'll say equals, and I want to go to cell G25 on my model tab, EBITDA of 60 million. Right, next thing we're assuming, and again, this is an assumption for our purposes. In real life, you're probably going to do a full valuation in order to figure out what the implied enterprise value of the deal should be. In this case, we're going to assume we're buying the company in a multiple of 6 times EBITDA. So I'm just going to hard code 6 in that cell. And then my transaction value, my enterprise value, is just the product of my 2008 EBITDA, multiplying that by that 6 times multiple. So B6 times B7, which gives me an enterprise value of 360 million.